Hello and welcome to another video on my YouTube channel. My name is Joris and today I'm going to start with a series of videos about how to evaluate a stock. And in this part 1 it's just going to be an intro. And as you know, a couple of weeks ago I also made a video about how important it is to do your own evaluations. So I wanted to elaborate on that video, and that's why I started this series. And I always say it, and I'm going to keep on repeating it. Saving is really hard. And investing right now is pretty easy. I know the days back when I was young and I had to take my mother to the bank and wait until I reached the counter and then ask the lady to give an order in the stock market for buying a certain stock. Most of the time she was surprised that she didn't know the company that I want to invest in, because I was investing of course in pretty risky stocks right then that were just beginning stocks, beginning companies. So after I knew that she wasn't really aware of which stocks were around, I always wrote down the easing code. I wrote down my price that I wanted to buy at, my limit price, and yeah, she completed the order. She printed it. Then my mother had to sign it. I had to sign it, and then it was filed into the stock market. And when it was executed, I got a message 2 days later. And back then in Belgium there was a quinzaine period, so the money was only withdrawn at the end of the quinzaine on Friday. So I had to keep track of my orders as well, because yeah, the money was actually gone from my account, but it was still there. And if I then put another order in and that one was executed and I miscalculated, I would be in the minus. And yeah, being in minus on an account, you immediately pay a high interest fee. So I didn't want to do that, so I had to keep track of everything myself. And now, with the apps that you have on your phone, you just deposit the money into the app of your broker. You receive it 1 hour, 2 hours later at a max here in Switzerland. Then, if you received it, you can go onto the app, select your stock, put in the limit order according to the bid and ask price that you see in the order book, and in a few seconds it's executed. You immediately see the money withdrawn from your account. So investing right now is really easy, and that can be a pitfall as well. So when it goes fast, you can make mistakes. So you have to really evaluate stocks before you go on your app and just do whatever you want to do. Because spending money is really easy. With one click, your money is gone. And with this being said, picking the right stocks is definitely hard. So if you pick the wrong stocks, you will lose money for sure. And how you need to pick the right ones, well, that's not that easy, but you surely have to remember rule number 1 of the 10 rules for dividend investors that I made a video about a couple of weeks ago. So you have to go for quality companies before companies with a high dividend yield. So don't chase dividend yield, go for quality stocks, and the dividends will follow later on. Even if they don't pay dividends yet, they will in the future. You see it with Meta, you see it with Apple, you see it with Alphabet. All those stocks will eventually start paying dividends, and in the beginning they will be dividend growth stocks because they start small, and then the amounts that they add to the dividends are a really high percentage compared to the previous dividends. So they will be then dividend growth stocks, and they will grow as well. And then later in the cycle, they will be dividend aristocrats, dividend kings, maybe. And if you invested early in those stocks, you will have had a really good run with that company on the stock market. So Charlie Munger, sadly enough, he passed away a couple of weeks ago. So he, at the Berkshire Hathaway meeting, once gave the rules for buying stocks. And the first rule that he said was, you have to understand the company. And the second one is, you need to know whether or not the company has a durable advantage compared to the other companies that want to do the same. So whether or not they have a moat around their business model. Then the most difficult one, in fact, for us to know as tiny investors is whether or not we can trust and believe in the management. So for that, you have to look at whether or not the bigger investors are also believing in them and like them. So you have to read a lot and follow the company a lot and hear what everybody is saying about the management, so you can more or less go from there. But making your own opinion, when you know the management personally, it's pretty easy, but that's quite hard for us mere small investors to do. And then, of course, the fourth point, and that is you have to like the price. And the price that you calculate yourself, you need to apply a margin of safety because, yeah, when you do your calculations yourself, you can make mistakes as well. So better safe than sorry. And about that fourth point, of course, this series is going to tackle that point. So the stock market right now, for me, it is hugely overpriced. I know not all companies are hugely overpriced, but a couple of them make it so that the market is actually pretty overpriced. And the thing is that when those stocks will not perform up to the level that investors that are investing in those stocks are expecting, then they will come crashing down and they will drag along the rest of the stocks with them. It's always like that. Also, the undervalued stocks that are on the stock market, when there is a crash happening of the big ones, they will be tumbling down as well. And that's why it's important that you follow along in this series so that you can make a list of stocks that you want to buy in the period that such a crash is going to happen. So that, yeah, you can take a provision of money and have a provisional list of companies that you want to buy at which price, so that when the moment is right, that you can strike. And the market is also extremely volatile. You saw it with Nvidia. They announced their numbers. They, yeah, they broke the estimate with 6-7%, and even it wasn't even 2-3 minutes after they started announcing their results that the stock went up 5% in the after hour markets. So the after hour markets, that's also not friendly towards us, the smaller investors, because most of the time we can't trade then, so we can't act upon that volatility. So when the stock goes up and we already have it, that's not a problem. But when the stock goes down and we already have it, then it's really a shitty situation. So that's the market right now. You see jumps of 5, 7, 10% almost every day right now. That wasn't the case a couple of decades ago. And as I said, you can't rely on evaluations given by investment banks or brokers, because yesterday as well, Nestle, they got a new evaluation from UBS, and they said it's or from another bank, I don't know for sure, but they said that you should be neutral towards it and not overweight it. And the price target was actually 103 or 105, moving down from 115. So they dropped the target price, but it's right now trading at around 94, 93 and a half Swiss francs. So when you look at that, there is actually an upwards potential of 8%, but the stock dropped 1% yesterday. So it's sometimes it's incredible, but don't go out from evaluations that are given by brokers that have their own agenda as well. Keep that always in the back of your mind. And also, don't forget that valuating stocks does matter, even though you have the book From a Random Walk Down Wall Street from Burton G. Malkiel from 1973, where they say that we are not better than dart throwing monkeys, because when you look at it this way, when you have 1 million, for instance, you win the lottery and you want to invest 1 million and you pick 10 stocks at random, and 9 go to zero and 1 doubles every 4 years. Well, after 13 years, you will have your money back. And if that stock goes up and up and up and it keeps doubling every 4 years, they will say you are a great investor, because with that stock, you will, after 13 years, you will start making profit. And after 20 years, you will have a really nice profit with one stock that doubles every 4 years. But it's mere luck, because you just, yeah, like the monkeys, you just threw a dart, they landed on those 10 stocks, you bought them, and you just went with it. But not selling that one stock and selling those other 9 faster than actually at zero, that is not luck. So when you do your own valuating of stocks, it's the thing that makes you keep a stock and not selling out of it that makes the difference. Or selling out of it and not keeping it that makes a difference. For instance, when you would have invested in Nvidia from the get-go and didn't sell until this point, you are truly, you are going to be a millionaire. When you only put 1,000 francs in from the beginning, you are certainly now a millionaire. But how many people would have done that? I don't think a lot of people put their money in 10, 12 years ago in Nvidia and kept it all the run through up till this point, where it is trading at 1,050 francs. So $1,050, I should say. So evaluating stocks does matter, but especially in the selling. And how to do it for stocks that make a profit, so that have earnings per share with an actual price to earnings ratio, that is what I'm going to mention in the next videos in a certain way. And remember, this is a simplification with pitfalls that you need to avoid, so you always need to apply a margin of safety. And stocks that don't make a profit yet, but promise to do so in the future, and often they promise a lot, they are even more difficult to predict than the ones that are making a profit. So normally you will make more mistakes there. So you really need to be careful with stocks that don't make a profit yet. And you will not hear me give advice on those stocks. So a couple of years ago with Amazon, they were putting a lot of their money that they made into R&D. They didn't make a profit, but it was a promising company. But if I had a huge YouTube channel back then, I would never say buy Amazon. And even now, I'm not going to say that you should buy any stock because, as you know, I have two stocks from the Swiss stock market and I'm not mentioning their name. They gave me a nice dividend this month, so I'm really happy about that. And I can reinvest it. I actually reinvested it this morning, but you will find out about that next week in the video, in my update video on my wife and mine portfolio. So with that being said, see you on the next video on my YouTube channel, and please consider subscribing to my YouTube channel. Hit that like button as well, it helps out the channel enormously, and see you on the next one. Bye.